Every collapse begins with a single, quiet event that the world mistakes for a glitch. In 1929, it was a ticker tape that couldn't keep up. In 2008, it was a few subprime mortgages in Florida. In 2026, the final domino is Ian or rebuilding it, is the total evaporation of the one thing that holds New York together. The illusion of solvency. We have watched the regional banks tremble. We have seen Blackstone, the world's largest landlord, lock its doors and freeze withdrawals as the smart money tried to sprint for the exits. We have walked through the zombie towers of Midtown, where 22% of the floor space is occupied by nothing but dust and unpaid debt. But now, we enter the final phase. This is the moment where the contagion stops being a financial term and starts being a lived reality for every person holding a bank card in America. The final domino is the realization that the system is no longer too big to fail, but rather too broken to save. As we speak, a silent high-speed digital run is happening in the shadows of the repo markets. This is where the world's largest institutions lend each other trillions of dollars every night. When the collateral for those loans, the commercial real estate, and the government bonds loses its value, the gears of the global economy simply stop turning. This isn't just about New York. It's about the day the money stops moving. Why is 2026 different? In previous crashes, the collapse moved at the speed of paper. Today, it moves at the speed of fiber optics. Your statistics show it. The silent withdrawal is happening. People are moving money with a thumbprint, not a signature. When the news hits that the final major insurer of Manhattan's real estate debt has been downgraded to junk status, the exit won't be a line, it will be a total system freeze. We are looking at a $1.5 trillion liquidity gap. This is the amount of money that has effectively disappeared from the valuations of NYC assets over the last 24 months. The banks have used accounting alchemy to hide it. Blackstone has used withdrawal freezes to delay it, and the government has used interventions to mask it. But the final domino is falling because you cannot print trust. You can print dollars, you can print headlines, but you cannot force an investor to believe that a vacant building is worth $1 billion when the windows are dark and the tenants are gone. To understand the final domino, you have to look at the repo market, the plumbing of the financial world. Every night, banks swap assets for cash to keep their operations running. For years, the gold standard for this collateral was New York real estate and U.S. Treasuries. But in 2026, the plumbing is clogged with zombie debt. When the largest banks look at Blackstone's frozen funds and the 22% vacancy rates, they stop accepting that debt as collateral. They say, "I don't want your paper, I want cash." But there isn't enough cash. This is the liquidity trap. When the banks stop lending to each other, they stop lending to you. This is how a real estate crisis in Manhattan becomes a national disaster that prevents a business owner in Texas from paying their staff. The dominoes are no longer falling in a line. They are falling in a circle, and everyone is standing in the middle. This is where the narrative shifts from spreadsheets to survival. The urban reset we've discussed in previous videos is now entering its terminal stage as the tax base of New York City craters, losing billions in revenue from those zombie towers. The city is forced to make a choice that will be mirrored in cities across the country. Do they save the transit system? Do they pay the pensions? Or do they keep the lights on in the streets? We are seeing the birth of a two-tiered economy. On one side, the institutional vultures who are waiting to buy the ruins for pennies on the dollar. On the other, the millions of workers whose retirement funds, jobs, and savings were tied to the bank domino. The final verdict of 2026 is that the system did not just break, it was outgrown by a new reality that it refused to acknowledge. The hybrid world, the high rates, and the end of cheap debt were the fire. The zombie towers were the fuel. The collapse of confidence is not a linear event. It is a chemical reaction that occurs when the last accounting lie ceases to be credible. Throughout our previous investigations, we analyzed how Blackstone locked the exit gates and how the zombie towers became glass tombstones in the heart of Manhattan. But now, we must enter the eye of the hurricane. The derivatives market and the insurance systems that were supposedly designed to protect us. In 2026, the reality is that the cost of insuring against commercial debt, defaults known as credit default swaps, has entered an upward parabola reminiscent of the darkest days of 2008. However, there is a fundamental difference that makes this moment far more dangerous. The sheer velocity of information. When the market perceives that the Calaterothos office building sitting at 22% vacancy is no longer worth even half of its debt, the financial system enters what analysts call a liquidity short squeeze. The institutions that sold protection on these buildings now find themselves facing billions of dollars in claims, but their own reserves are trapped in assets they cannot sell. It is a financial Gordian. It isn't just that Blackstone cannot return money to its investors. It is that the banks that lent to Blackstone are watching their own solvency ratios sink into the red. This leads us to the phenomenon of the systemic margin call. When property values drop below a critical threshold, lenders demand immediate cash, and in a world where cash has become the scarcest commodity, the only option left is to sell anything, at any price. This forced selling is what finally topples the last Domino. Imagine one of the most iconic towers on Park Avenue being auctioned off for a mere 30% of its 2019 value. That single transaction acts as a death sentence for every other building in the city. If that one tower is worth 70% less, the bank holding loans on the 10 adjacent towers must, by law, mark those loans down to their new real-world value. In a single day, billions of dollars in bank capital simply vanish from the books. This is no longer a crisis of cash flow, it is a crisis of existence. Regional banks, already weakened by the silent run on deposits we analyzed earlier, suddenly find that their asset base has evaporated. The panic is no longer just among retail depositors, it is an institutional panic. What we are witnessing at this point in 2026 is the end of cheap money as a foundational concept of modern civilization. For 20 years, New York grew under the premise that interest rates would always stay low and that real estate would always go up. But the final domino teaches us that debt is a form of time travel. You are bringing consumption from the future into the present, and the future has finally arrived to collect the bill. The interconnection between pensions, insurance, and commercial real estate has created a web where no one is safe. If a New York firefighter loses his pension because the fund was invested in Blackstone's debt, and Blackstone falls because the offices are empty, the negative feedback loop becomes unstoppable. The city loses tax revenue, essential services are cut, and the value of residential homes begins to follow the downward path of the office towers. This is the moment when government intervention usually appears. But in 2026, the Federal Reserve's balance sheet is already overextended from years of fighting smaller fires. The bailout that everyone expects might not be coming this time, or if it does, it may come with strings that change the nature of private property forever. We are entering the intervention phase, where the line between the state and the financial market disappears. As the final domino falls, it isn't just taking down buildings and banks, it is taking down the very concept of the American dream that was built on leverage. The urban reset is no longer a forecast. It is the new reality of the 21st century.